What is the difference between putting gold in a Roth IRA or a traditional IRA? Welcome to the Noble Gold Investments Investing in Gold series, and we're getting really close to the end. For this part, let's discuss the difference between a Roth IRA versus a traditional IRA and hopefully get you closer to determining which one is right for you. By now, you should know that a gold IRA is just a common language term for gold investments in a self-directed IRA or an SD IRA. In a self-directed IRA, you can put other types of investments managed like a managed IRA won't allow. That includes physical gold. So when you say gold IRA, we actually mean a self-directed IRA with gold in it. There are two types of IRAs, traditional and Roth. Traditional IRA is a tax deductible on both state and federal tax returns. For the year, you make the contribution. When you liquidate or start receiving distributions, you're taxed at your income rate when you get the money or if you take the asset in kind, presumably in retirement. So if you put $5,500 in 2022, then you will get tax deduction when you file your taxes for 2022. Under a Roth IRA, you don't get a tax deduction when you make the contribution. Instead, when you liquidate your Roth IRA during retirement, you don't pay a dime. That's because you pay the tax bill up front. However, to qualify for a Roth IRA, you must have a modified gross income of $144,000 or less for 2022. The modified adjusted gross income for married couples filing jointly is $214,000 or less. My personal favorite is a Roth IRA for several reasons. Most obvious is the tax shield that you'll enjoy on your investment, and it's going to grow by leaps and bounds. If you buy 100 ounces of gold now, you don't get a tax break now on that, over $200,000 investment. But in this case, that could be a great thing. 20 years from now, when gold's sitting at $5,000 an ounce or more, you would have potentially a $300,000 capital gain. But in a Roth IRA, that would be tax-free. So that's why I really think it's a benefit. Roth IRAs don't have a required minimum distribution. With a traditional IRA, you have to start taking RMDs, which are mandatory taxable withdrawals of a percentage of your funds at the age of 72, even if you don't need the money. With a Roth IRA, you don't have to withdraw any money at any age or during your lifetime at all. You can hold out for as long as you want. If you have kids, this is a good way to pass on wealth. Beneficiaries of Roth IRAs don't owe income tax on withdrawals either. Though they're required to take distributions or roll the account into an IRA of their own. Unlike a traditional IRA, you can withdraw money tax-free and without penalty at any time for any reason, even before age 59 and a half, after the required 5-year holding period. So why do some people like going with traditional IRAs? Some say they can use the tax break on other investments to set up a business, and I think that's a valid argument, especially if you end up running a business to grow and maybe you make more than that tax savings. But obviously there's pros and cons with traditional and Roth IRAs. The difference between the two IRAs, and we'll really dive into it and take a look at it in this next video, and you can look at how gold plays into that. But let's take a look at that next video so you can really learn about it and get a feel for it.